Welcome everyone to today's session. So we're going to talk about trading in the after hours against options. There was a little bit of demand for this topic again. So we're going to do it in a little bit more structured way. We're going to talk about synthetics first, just so you get an idea of why this works and how to execute it, the different pieces that go into this particular strategy. So we'll talk, don't worry, it's a big word. Synthetics is a big scary word, but it's going to make sense in a moment. And we're going to talk about how we use that concept to lever up our stock buying and selling to transform a position into what we need it to be. That's what we're going to be doing today. We're going to be transforming a position that we have into the opposite position. So turning a call into a put or turning a put into a call, which is pretty cool. Not quite the alchemist turning things into gold, but maybe, just maybe, if things turn out the right way afterwards. And so let's take a look here just quickly about me. 30 years in the business, 12 years as a professional options market maker. So this is the kind of stuff I've really had to learn early on in my career, right? So this is the kind of trade that I've done hundreds of thousands of times in the sort of course of hedging off risk in my book. So for many years, I would have to do exactly this, which was, clients would come in and they'd sell me a whole bunch of calls at the top after a big run in the stock. And I'm not happy owning a whole bunch of calls up there. So what I can do is I can turn all of them or a portion of them into puts. And that allows me to effectively use stock to sort of skew the view of my portfolio in any direction I want it to go. So, and then 13 years managing a lot of option ETFs. So option selling funds, Black Swan protect type products, downside protection. So $1 billion in option strategies managed over the last almost 30 years, a lot of cash flow generated on the options harvesting side of things. And I've done tons of media, all kinds of cool stuff. So a lot of experience there. Just so everybody knows, again, this is for educational and information and maybe entertainment purposes. If this kind of thing gets you excited and you find it entertaining, so could be for entertainment purposes as well. It is not investment advice. I am not a financial advisor. I am not going to tell you to go out and do these things. Before you do anything on here, you need to consult with an advisor, consult with your tax expert that it happens to be on your team, your accountant, et cetera, figure out the tax implications of these kinds of strategies, et cetera. So let's move on. Let's talk about synthetics. So the core of the strategy is really these first two items on this chart. First things to know, option synthetics. We're going to ignore the carry and the dividend, right? Those have a place in these things here, but we're going to look at a stock called Lyft. It doesn't have a dividend, and we're going to ignore carry for the moment. We're going to be talking about shorter term options where carry doesn't have much of an effect. So let's keep things simple for the purposes of really illustrating how this works. Long call plus short stock equals a long put. Okay, this is called a synthetic put. So this is what I'm talking. I turn one thing into something else. I'm turning my long call into a long put by adding this middle piece here, which is shorting stock. And then the opposite, with a long put, I can turn it into a long synthetic call by adding this middle piece, which is buying stock against that long put. So these are the real basic synthetic. You're going to hear synthetics spoken about in a number of different ways when it comes to options. Buying stock synthetically, using just options, things like that. But in today's session, we're really going to talk about how we can use the concept of synthetics to really alter the position that we want to have, right? And this is going to come in really handy when we look at a potential position after hours on an earnings pop. So let's take a look. Let's take a look at our old friend Lyft, our forgotten competitor to Uber, always trying hard, always comes back and always fails again. It's just difficult to compete against the great Uber. So we are going to take a look at our basic call right now. So let's take a look at Lyft. Let's assume that the earnings are about to come out tonight. We are looking at options that expire in 2 days. So I'm going to come out and I say, I think the earnings are going to be great. So I'm going to buy the 12 calls. Let's assume that we pay, let's say 40 cents for those, because 2 cents is obviously not enough. With earnings coming out, they're going to be jacking up the implied volatility here. I'm going to buy 10 of these for 40 cents. I'm going to commit $400 to this trade, and let's see what it looks like. All right, so here's your standard call structure, right? We have 40 cents to lose times 10 contracts, which is $400, which you can see down here. And then on the way up, our expiry line shows us that our break even, of course, is $12.40. And then beyond $12.40, we are actually going to benefit from any further appreciation in this particular stock, right? Makes sense? Makes sense. Now, what if earnings come out and in the after hours, Lyft pops to $13? This is our scenario. What if Lyft goes from $11.50, where it is right now, to $13? We have this call that we're long at 12. Now, under normal circumstances, what I've seen done way too many times is somebody will exercise that 12 call, which gives them 1,000 shares. So in the after hours, they will exercise that 12 call, especially if those calls expire today, for example. They will exercise it, and they will go ahead and sell their stock at $13. So what does that do? Well, you're locking in a 60-cent profit. You've paid 40 cents for this, the ability to buy stock at 12. That means your break even is $12.40. You've sold your stock at 13, and you've locked in a 60-cent gain, and the position is gone, right? Because you've exercised those calls, you've bought stock there, you've sold stock in the aftermarket, and that wipes out the position. You come in the next day and you have no position anymore. Now, let's say you're concerned that we're going to get a little pop in the aftermarket to $13, but that the earnings call may not go as well. That the CEO, the CFO, whomever is going to come out and start talking about how the economy is challenging, the consumer is challenging, et cetera, et cetera. Let's say this stock goes back down to $11 in the aftermarket. Okay, let's assume it drops from 13 back down to $11. You are still long this 12 call if you haven't exercised it. So this is what I'm saying is the correct way. We do not exercise options before expiry unless there's an ex-dividend date coming. And then there's a number of different things you have to look for in order to decide whether you're going to exercise those. But you do not exercise calls ahead of time because you're giving up this synthetic put. Let me tell you how this synthetic put works. If I sell stock at $13 and I own the 12 call, I've now locked in my 60-cent gain. I cannot ever lose more than 60 cents, right? Unless this is like GME or some sort of hard to borrow stock, the high borrow rate, they force you to cover something like that. But under normal circumstances, on a relatively normal stock, I've locked in my 60 cents. But now what happens when it goes to $11? Well, now the stock that I'm short, this 1,000 shares that I've sold, I'm able to make money on all the way down to Lyft at zero, in theory. But it's only going to $11. So what have I made? I've made $2 on the stock, right? From 13 to $11. I cover my stock at 11. I'm still long these calls. So effectively, in theory, I've made $2 on the stock. I've lost the original 40 cents because we're going to assume that they go down to zero tomorrow. I'm going to lose 40 cents on the calls that I purchased. So net, I'm up $1.60. So look at what's happened there. Let's write this out. So I sold stock at 13. I bought stock back at 11. So I've made a $2 gain on that. I've lost 40 cents on the calls that I paid 40 cents for. So net, I've made $1.60, right? I've made $2 on this stock, scalp, and I've lost 40 cents on the call. So I've made $1.60 net. Now that's very different from the person I just told you about who exercised their calls at 12, then sold stock at 13. What did they make? Well, they made $1 from the 12 purchase and the 13 sale, less the 40 cents they made. So they only made 60 cents. So here's your difference. In this particular case, I made $1.60 times my 10 contracts. So I made $1,600. In this case, I made $600. I only made 60 cents. Why is that? Where does this extra $1,000 come from? Where did that extra $1,000 come from? It came from the synthetic put that I created when I sold stock and held my 12 call. Did not exercise the 12 call. By not exercising that 12 call, I've given myself the ability in that earnings call, whatever it is they start to say, I've given myself the ability to buy that stock back at a lower price. Now, what if they come out and they say something that everything's looking great and it doesn't go down? It stays at $13. If it stays at 13, nothing ventured, nothing gained. I don't lose any more if the stock stays at 13. So I have a synthetic put that's worth 0 and it just goes away, right? The calls, the position just stays the same the next day. I'm long the 12 call and I'm short stock, and I can see how that works out until expiry. Now, if the stock goes from 13 to 15, well, then I've given up the extra $2 of gain from 13 to 15. But that doesn't matter. I was going to exercise at 12 anyway and sell my stock at 13. So I don't consider that as something that really affects this particular scenario, because I wasn't going to get that extra $2 anyway. I was going to exercise my call in the aftermarket at $12 and I was going to sell my stock at 13. Right? So this doesn't really matter. Either way, I'm going to give up those extra dollars above 13. But let's take a look at what I've done here. I've created this synthetic put. So let me actually add the 1,000 shares for you to let you see how this looks. Okay, so let me look at add simulated trade. I'm going to sell 1,000 shares against those 12 calls. And let's look at what it looks like. Oops. I'm going to sell 1,000 shares. There you go. So look at, what if I remove the stock from our risk analysis here? There's our call. What if I add the stock, the short sale of 1,000 shares? It's long a put, right? I'm now long a put under $12. So if I put in $13 here, I'm now long a put at $12 that has an absolute worst case scenario of making $600. Remember I said I locked in that $600 by selling stock at 13. I've locked that in. So if the stock goes to $30, doesn't matter. I'm still going to make my $600. I'm long a call. I'm short stock. They offset each other. There's nothing more to be done except at some point exercise these on expiry. But below 12, watch what happens. I now have a free synthetic put. I have 10 puts to the downside that can continue to make me money. If the stock goes to 11, I make 1,000 extra. If it goes to 10, I make 2,000 extra. Can't see it on here. There we go. There. See, I've made an extra 2,000 plus the 600 that I originally made. If it goes to 9, I've made an extra 3,000 plus the 600 that I originally locked in, right? Now, I'm not going to hold until 9 unless it immediately ticks there. I have no choice to buy it at 9. I'm going to probably buy it on the way down when they start yammering about whatever's going on with the company. But the point is, you've created, by leaving this position as is for the time being. Now, if it expires today, you need to execute all of this, everything I'm talking about, you need to figure out by about 5:15, 5:30 Eastern. Because if the stock trades at 13, you sell your stock, and it doesn't drop after 4 o'clock, then you're going to have to put in an auto exercise, because it's not going to auto exercise at 11:50. So you need to be aware that if these expire today, there are some things to do, very, very important things to do. If this doesn't expire for a couple days, leave the position on. You're long the 12 calls, you're short stock. This is probably going to work a lot better in a margin account where you're allowed to do something like this. You need to make sure you're allowed to do this. And you're effectively going to short stock, right? That $13 sale is a short. So you need to be able to short stock against those calls and be able to do something like this. So this is kind of a fun thing that you can try out in a paper account. Make sure you kind of get it. Try it out on a few earnings releases, right? Play with going in long calls. Play with going in long puts. The put situation is actually the opposite of this. So let's say Lyft closes at 11:50. I buy the 11 puts. Let's say I pay 75 cents for those. This is what my profile looks like, right? It's got to go down 75 cents before I break even. But let's say the stock goes to 9.80 in the after hours. Again, do not exercise these puts in order to sell stock and buy the stock back in the market after hours. You are giving up a synthetic call this time, right? This is a synthetic call. So when you're long the put, you can buy some stock against it and turn it into a long synthetic call. So let's take a look at how that looks. I'm going to add a simulated trade of 1,000 shares at, let's say, 9.80, and see how that looks. Now look what's happened. I'm going to remove the stock. There's my long put. That's what I went into earnings with. Then I buy my 1,000 shares in the aftermarket at 9.80. I turn it into a call. Put, turned it into a call when I add that 1,000 shares of stock. I've turned this into a synthetic call that is locking in 45 cents, right? Worst case, if the stock keeps going down, I've locked in my $450. But if it goes up, I now have a free call at the 11 strike. So if something comes out, if during the earnings call they say, well, you know what, things are actually fantastic. Our numbers weren't great, but boy, things are looking amazing. And we signed deals with all these companies and you know, we're going to start delivering food and et cetera, et cetera. And this thing rallies to $12. Well, what can I do? I've bought stock at 9.80. I can now sell it at $12. And now I don't have to exercise those puts. Now I've scalped that for $10.20, or for $2.20 rather, for $2.20 from 9.80 to 12. And I let the put expire worthless, or I hold on to it for the next couple days. So pretty cool ways to kind of do things. Now, do I have to do all 1,000 shares in these particular trades? No, you can do half. Watch what happens here. If I only buy 500 shares against my 1,000, let's say I'm thinking I'm going to buy a little stock in the aftermarket, but it might go down even more. So I'm going to buy half. Well, look what it turns this into, a kind of a straddle. And there's an easy way to figure out why that looks like a straddle. It's because you're long 10 puts, you add 500 shares. What are you left with? Well, 500 shares offsets with 5 of those puts and becomes 5 synthetic calls. So now you have 5 of the original puts plus 5 synthetic calls. What is this position? It's a straddle. There's your straddle. So you don't have to go all in on these trades. You can buy half, you can buy some. And in fact, this is how a market maker who generally trades long gamma, long option positions, goes about his or her day. They scalp back and forth. You know, if the stock rallies, you can sell. The stock falls down, falls off, you can buy. You buy on the delta. It's called trading the bend. I'm going to leave that for another session and lesson at some point. But hopefully that was kind of cool for you guys. Hopefully it makes a little bit of sense. Just wanted to remind everybody that I've got a couple of programs here. I've got the 4-day option trading challenge, which is totally free. Sign up here, crushthepremium.com, 4-day challenge. And I'm going to talk about a number of the pillars in my system, how I go about selling options in a very risk managed way, right? Risk management is what it's all about, especially these days. We've seen markets do crazy things. We've seen historic moves almost in VIX, in VVIX. Some strange things are going on out there. There's a big sea change happening. And so risk management is really the name of the game with option selling. You can have 9 out of 10 positive trades and do well, and that last trade costs everything you made and double that, right? Win rates have nothing to do with the game of option selling. You need to have a sense of risk management in our Discord program, which you get when you take this Crush the Premium course, the enhanced wheel option system. You're going to get 6 months in the Discord community where we have risk gauges, hedging, we've got chart packages, we've got all sorts of cool stuff in there, great research to help you do this the right way, not just throw darts at the board. Now, my current bundle is going to be the Crush the Premium option selling system, which is what I just talked about here. Talks about 4 pillars of edge that I focus on in order to build my approach to finding good trades. And then I'm going to throw in the Gamma Options Mastery course, which is 16 hours of videos, and my Condors course, which is another 1.5 hour session. Teaches you Condors from start to finish. And of course, includes the very important concept of volatility. I include volatility in everything I do. I look at VIX futures, I look at the VIX, I look at all kinds of measures of volatility in order to formulate a view of what markets are doing and where the risk is. And when the risk is too high, when the edge isn't there in doing something, we don't do it. And that's the key to surviving in this game and thriving in this game. It's not the positive trades all the time. It's staying away from the really bad, the trades that become really destructive to your portfolio. Those are the portfolio enders. Those big trades that you just let get away from you. That doesn't mean we're never going to have a bad trade, but being a pro is being able to adjust to that reality and do something about it. So with this bundle, you get 6 months in the Discord community, and it's $777, whereas the option enhanced wheel selling system is $497. So for a couple $100 extra, you get the entire Gamma Options Mastery course, and you get the Iron Condors course. Now, with both of them, you get 6 months in the Discord community, so you get that as well with the enhanced premium. So hopefully that can pique your interest. If not, or if you want to talk about any of this stuff, reach out to me. Here's the email, or if you know my Twitter handle, DM me, and we can talk about any of this stuff. I'm happy to talk about anything, no pressure. Take the course, don't take the course, it's fine. I'm happy to just talk shop as well and answer a couple questions about things because I know that this is a relationship game, and one day you might need something more than that, and I'm here for you when that happens. So reach out today, and hope you enjoyed it, and we'll see you next time. Bye-bye.